Since the Iran war began in late February, the headlines have felt relentlessly negative. The Iran conflict has triggered a 50% increase in oil and gas prices. It's triggered higher inflation, and with it, higher interest rates, which raises the borrowing cost for both individuals and consumers. And it's also taken the idea of any Fed rate cut off the table for the near-term future. So when you think about all of that bad news baked into the market, if I would have told you the end of February, all that was going to happen, and to project what returns would look like a few months later, you might guess down 10%, down 20%. But lo and behold, stock prices have actually risen by 10% over that time frame. How is that possible? To answer that question, I'd encourage you to think about it within the context of one of our favorite family summertime traditions, heading to the beach. When we get to the beach, what's the first thing that catches our attention? It's the waves, right? It's the size of the waves. It's the loudness of the waves. But what actually controls the level of the ocean? It's actually the tide, not the waves. I'd encourage you to think about the current marketplace in the exact same way. Right now, all the financial headlines that are scary and loud, those are the waves that we're feeling and seeing. But what actually controls stock price levels is the tide, and the tide here being corporate earnings. When you look at corporate earnings year to date, in the first quarter, corporate earnings grew by 28% year over year, the highest level since the fourth quarter of 2021. And as we look at second quarter earnings season, it's expected that corporate earnings growth in the second quarter will be more than 20%, which is actually double the 10-year long-term average. Why is this so important? Because stock prices follow earnings over time, and rising earnings expectations are fuel for stock prices. When you add that to the fact that the economy continues to prove resilient, the consumers are still spending, which makes up 2/3 of the economy. Business investment is significant as they continue to make investments in AI. Unemployment remains low. It provides a solid backdrop for corporate earnings growth to continue to be successful. So when we think about the Iran war and what actually happened versus what investors may have expected with all this bad news, it brings to mind one of my favorite quotes from Mark Twain. It's not what you don't know that gets you in trouble. It's what you know for sure that just ain't so. Looking forward, no one knows when and how this Iran war will end. We have to remember, no one predicted the Iran war, and no one predicted the rally that came with it either. So looking forward, there's likely to be lots of financial waves to continue. But as investors, we want to focus on the tide. We want to focus on earnings, not the headlines. And remember, the best investors have a financial plan that prepares for the unexpected rather than trying to predict it. Markets are near all-time highs, despite all the worries in the financial headlines. Worries around the Iran war, around rising oil prices, around inflation, interest rates, the Fed and the new Fed chair, as well as upcoming midterm elections. It has investors asking, we're at new market highs and all these headlines are worrisome. Shouldn't we be doing something? And that feeling is called action bias. That idea of don't just stand there, do something. And when you think about action bias, a really good way of explaining it is actually a research study that was done, believe it or not, on soccer penalty kicks, which aligns really well with the summer craze around the World Cup. And what this research showed was that it looked at 300 penalty kicks to decide, based on penalty kicks and where the goalie dove left or right or stood in the middle, what was the optimal position for a goalie to stand to give them the best chance of stopping the ball. And actually, only 6% of the time did the goalie stand in the middle and not dive left or right. So why is it that they dove left or right so often? Because they wanted to say, at least I tried. Despite the fact that standing in the middle and doing nothing gave them the best chance of stopping the ball. So how do we relate this to investments? If you look back in history, what you often find is that investors have often dove left or right to their own peril. Go back to 2009, the great financial crisis. Stocks fell by 55% over an 18-month period. Many investors panicked and got out of the market. What they missed was an astounding 400% rebound and the longest bull market expansion in U.S. history over the next decade. Fast forward to 2020 and COVID. When COVID hit, stocks fell by 33% in a month, and many investors panicked. You don't get a 33% decline without a lot of panic. For those investors who stayed invested, they saw markets actually yield a positive return for the year 2020, and by the end of 2021, stocks had actually doubled from their 2020 lows. And one final example is Liberation Day in 2025, when stocks plunged by 10% in 2 days. But from there, stocks climbed for the remainder of the year, finishing positive by double-digit returns in 2025. And through the second quarter of 2026, stocks were up by roughly 50% since the Liberation Day lows. So as we think about the context of diving left or right for investors and worries about all-time highs right now, it's important for investors to remember that market highs are a feature, not a bug, and that every major fear peak in the past decade has been followed by a recovery. So when we think about action bias, that desire to don't just stand there, do something, we want to leave you with 3 pieces of advice to consider. 1, acknowledge the urge. We all have that propensity to not just stand there to do something. Acknowledging that urge will reduce its power over you. 2, trust the track record. Every stock market decline in US history has been followed by a recovery and a new market high. Trust history. And 3, let the headlines of your life dictate changes to your financial plan, not the headlines of the news. And remember, you don't have to dive left or right to prove you're in the game. If you have a financial plan, you're already in position.